how to pick the best dividend stocks. If you're like me and your main focus from investing is to generate steady passive income, this is the question that will spring to mind quite often, and it's certainly the question that I get asked quite often either through my YouTube channel or through my Instagram account. So that's the main thing that we're going to focus on today, and hopefully we'll get some answers from the video. Just before we get started, if you haven't already, please subscribe to the channel and also hit that like button as well if you enjoyed today's video. Investing in dividends is a slow and steady method of investing. However, as we all know, slow and steady wins the race. For example, if we look at Warren Buffett, he's known for investing in top-notch dividend-paying companies. This has helped him build his wealth over decades. As you can see here, it has grown massively in recent times. He's also known for the following advice: always reinvest dividends. Reinvesting dividends is a lucrative tactic in investing, especially since dividends will give you inflation protection, whereas most bonds will not. This is a post that I put up recently on my Instagram account, and it's very clear to see the benefit of reinvesting any dividends that you receive. So far, it might sound like a simple strategy: find a company that pays dividends and reinvest those dividends over the years in order to build your net wealth. However, it's not that easy, unfortunately. You need to make sure you're placing your bets on a quality name. Quality is absolutely key when it comes to investing in general, but especially with dividend investing. Otherwise, you could be seeing the likes of dividend cuts, dividend elimination, and stock price depreciation. And I can assure you these are three factors you definitely don't want to be seeing happening. I've experienced some of them before, but I'm working hard to try and avoid them in the future. So with that in mind, in this video, we're going to look at different considerations when picking the best dividend stocks. With consideration number one then, we want to look at consistent profits. If a company isn't steadily profitable, scratch it off your list. Forget about it, move on. It's possible to see healthy dividend returns from companies that are delivering profits but not profitable growth on an annual basis. But since dividend paying companies showing profitable growth exist, there would be no sense in choosing the former. Tighten up your parameters and only consider companies delivering profitable growth. Look for long-term earnings growth expectations between 5 and 15%. The reason you don't want to go above 15% is due to the increased likelihood of earnings disappointments, which almost always nick the stock price. So with that in mind, you don't want to go too low or too high. Really aim within that window of 5% and 15%. Okay, so if we move on then and have a look at consideration number two, which is all about debt. You want to stay away from it as much as possible. Avoid debt. In order to determine a company's debt situation, look at its debt to equity ratio. If you're not too sure what that is, I have included the ratio here. So you want to take short-term debts, add them to long-term debts, and also add on other fixed payments, and then divide that by shareholders' equity, and that will give you the debt equity ratio. If the debt to equity ratio is too high, look elsewhere. Again, forget about it, move on, choose someone else, pick a different company. Every investor is different in regards to what debt to equity ratio is too high, but consider excluding any company with a debt to equity ratio north of 2. Ideally, you want to see a debt to equity ratio below 1, which will allow you to sleep better at night. Trust me. If there is debt, then a company is more likely at some point to try and pay it down. When this happens, it means that extra cash is going towards deleveraging instead of dividends. Therefore, high debt will most likely lead to dividend cuts, or certainly less dividends in the future, less growth. Okay, so moving on to consideration number 3, check industry health. This factor often gets overlooked, but it really shouldn't. For example, when major integrated oil and gas companies are suffering due to a plunge in the oil price, the stocks should sell off, and due to weakening global demand and oversupply, stock price appreciation and dividend increases aren't likely in most cases. If you take a look here at the oil price over the last couple of years, you can see the very recent decrease, massive decrease due to the coronavirus pandemic. What's happened? Well, if we look at the likes of the major oil and gas companies, Shell, BP, ExxonMobil, their share price has taken a massive hit, but we've also seen an impact on dividends. If you take Shell then as an example, since World War II, they've been steady with their dividend payments. However, for the first time since World War II, just very recently, they've had to cut that dividend. So it's very important to look at the overall industry health. On the other hand, with baby boomers aging, the demand for healthcare services will be through the roof over the next 2 to 3 decades. This doesn't mean healthcare stocks are immune to broader market plunges, but they're likely to be more resilient than most stocks. And as long as the industry is in boom mode, there is more of a chance for dividend increases. So really the conclusion here is don't just pick a stock based on its own individual history, have a look at the overall industry that it is involved in. So let's move on then and look at the fourth and final consideration for picking dividend stocks. It's really important to review the dividend history of any company that you're considering to go with. As the saying goes, there's no point reinventing the wheel. However, on the other hand, it's also important to remember that past performance is no guarantee of future performance. There's 2 key groups to focus on. We have the dividend aristocrats and the dividend kings. Firstly, we'll look at the aristocrats. So a stock with 25 years or more of consecutive dividend increases and is also part of the S&P 500 is known as a dividend aristocrat. Really, the next level up then from that, if a stock has 50 years or more of consecutive dividend increases, they are known as the dividend kings. So it's really quite an elite group. Again, there's no guarantee that there might be not a cut in dividends in the future. However, if there's anything as a safe bet, dividend aristocrats and dividend kings are definitely worth considering. However, as always, please do your own research. If we look at the aristocrats then, so 25 years or more consecutive increases, you can see the likes of Coca-Cola, Chevron, AT&T, Johnson & Johnson on there. Then if you look at dividend kings, this is a post that I had on my Instagram recently. Again, there's some crossover, but you've got other companies on there like 3M, for example, but Coca-Cola, Johnson & Johnson still make it onto the same list. So definitely worth considering. One very good example, just to finish off the video with, is Johnson & Johnson. If you're not aware of them, they're a huge American company involved in pharmaceuticals, medical devices, consumer goods. The first chart here is their profits per quarter over the last number of years. As you can see, definitely heading in the right direction. The second chart here is the dividend payments increasing year on year. So I hold Johnson & Johnson within my portfolio personally, but I think they're a great choice for anyone to consider adding if you haven't done so already. Okay, so that's it guys, coming to the end of the video. Just a quick summary then to finish off with. So when you're looking for a good dividend stock, the first thing to look for is consistent profits within that company. The second thing then is to really avoid high levels of debt as much as possible, because there's a fair chance that'll actually lead to dividend cuts or elimination altogether in the future. The third consideration we discussed is about the industry that your potential stock is within. So the oil and gas industry, for example, affecting the overall companies within it. And then the final consideration then is I would recommend having a look at dividend aristocrats or dividend kings. As we mentioned before, and it's worth remembering, past performance is no guarantee at all of future success. However, it's certainly worth bearing in mind whenever it comes to selecting dividend stocks for your portfolio. So all that's left to say now is thank you very much for watching. I'll leave a few other videos here. Please go ahead, check them out. As always, if you enjoyed the video, please hit the like button, and please also subscribe to the channel so you can stay up to date with my future videos. So I will see you all again soon.